Welcome to Multifamily Investor. I'm your host, Andy Hagans, and today we're talking about the tax benefits of private multifamily funds, but specifically the questions that limited partners need to be asking when they're evaluating different offerings, when they're doing due diligence. I think this is a tremendously important subject. So I'm very happy that joining me today is Michael Johnston, host and founder of the Tax Efficient Investor podcast. Michael, welcome to the show.
Andy, always good to be with you.
And we did a replay a couple episodes ago where I was on your podcast. I replayed that content for our audience here, but I really wanted to get you on this show to drill into a little bit more detail. Some of these tax benefits, and the fact that every multifamily deal is different, right? So we can't just like have an episode here and say these are the tax benefits you're going to get when you invest in a private multifamily fund, because every deal is different. And I also want to say, we recently on the show here, I had Jimmy Atkinson on. We talked about the tax benefits of a few wrappers, Delaware statutory trusts, qualified opportunity funds, and opportunity zones. But I wanted to dive into more broadly the tax benefits of really any private multifamily fund, right? Because there's so many syndications, so many deals that aren't in either of those wrappers, right? That I can just take cash that I want to invest, put it in a fund. Hopefully that fund starts throwing off income and I get some tax benefits. But I want to start, Michael. This show's for LPs. I'm an LP. You're an LP. We want to produce content for LPs. So much of the content out there about tax benefits of real estate or multifamily is really if you're the active operator, right? If you're the general partner in a fund, or if you directly own real estate. So are there major differences in the tax treatment if you are a general partner in an offering versus if you're just a passive investor or an LP?
Yeah, great question, Andy. And I love that you're covering this topic from this perspective for a couple of reasons. One is, part of why I started the show that I host, the Tax Efficient Investor, is I always find it frustrating when you're asking questions about taxes and when the extent of the answer seems to be, oh, well, it depends. And
Mm-hmm.
that's a fair answer because it's usually true. Like the
Of
tax
course.
code is complicated, it's thousands and thousands of pages, and it's hard to give blanket advice. So that's a fair answer. Like it always depends. There's different flavors of deals. But you've got to tell people what it depends on. And if it depends, what are the questions they should ask, or how do they actually analyze it instead of just leaving it at it depends. So we're not going to be able to provide blanket advice or make some blanket statements here, but we are going to give you some specific questions that you should ask to get to the bottom of it if you're an LP thinking about investing in multifamily real estate. And then also, Andy, to your point, there are differences between general partner tax advantages and limited partner tax advantages. And almost all of the conversation or the content that I hear focuses on from a general partner perspective. But there's a lot more LPs than there are GPs, so it's never quite made sense to me to cover it only from the GP perspective. And there's some differences. So, for example, the carried interest loophole, or maybe we shouldn't use the word loophole, but the carried interest tax benefit generally is going to apply only to the general partner. That's not something that the limited partners are going to be able to take advantage of. And then there's some pretty significant differences when it comes to the tax benefits of depreciation as well. And unfortunately, the benefits are typically better for general partners than they are for limited partners. But the good news is there are still definitely tax advantages for LPs in multifamily deals in terms of depreciation and on some other fronts as well.
Potential tax advantages, right? And that's why we're asking these questions. So
Yep.
it's kind of like, I've just watched a presentation, I've seen the deck, maybe I've reviewed the offering documents, the GP or their investor relations or whoever gets me on the phone. It's my turn to quiz them and say, before I wire you the money, I got to do due diligence. And I also have
Mhm.
these tax questions. Back to your point about most of the content that's being produced about tax advantages is geared towards GPs. Is that because they're producing it for like literal GPs in like funds, or is it just more geared towards, do you think, just people actively directly owning real estate? Because that kind
I
of
think it
surprises me.
Yeah, I think it's geared towards people actively managing real estate, but also those tax benefits are better, right? And it's more fun and it makes it sound sexier if you can cover, if you
Hmm.
can make it look as good as possible, right? If you can make these tax advantages seem like a 10 out of 10. I'm writing about something that's a 7 out of 10. Like that's still really exciting to me. But it's maybe not as exciting to cover. But I think also, Andy, a lot of people just don't go into the details here. They don't sweat the details. They don't think about the fine print, and it's important to make those distinctions between GP and LP.
Yeah, totally. Also from a liability perspective, and that's the other side of the coin. Like with oil and gas deals, a lot of times, even if you're coming in as a passive investor, they'll give you an option to come as a GP to get different tax benefits. But in that case, then you got to realize, well, that might come with different liability, right? So at the end of the day, being an LP, I love being an LP. It's like it's not my headache, it's not my liability. You can always lose money, but just even that, it's not my headache, it's not my liability. So let's now turn to these questions, right? Because as an LP, you don't want to be I don't want to say the dumb LP, but I mean that maybe that's appropriate where you get wowed by a deck. You're like, the IRR looks great, the sponsor has a great track record, and you don't even ask any questions, right? Like you should at least have some intelligent questions to ask. And Michael, in your view, there are a set of questions that you really need to ask for every single deal relevant to taxes as a limited partner, right? So what are those questions?
Yeah. So let's dive in here, Andy. So the first question that I would always ask is, what is the tax status of this deal?
Hmm.
And in most cases, they're going to tell you that it is an LLC that is elected to be taxed as a partnership. And that's good and bad. It's mostly good. It's mostly good because if it's taxed as a partnership, that means that gains and losses are going to flow through to you. It's a pass-through entity. So those gains and losses are going to flow through to you on a K1. So you're going to get a form K1 each year, and it's going to have essentially, to simplify things a bit here, your share of income, losses, and depreciation, which we'll talk about in a minute. So that all flows through to you on a K1 each year. Now, the bad part about that is that you get another tax form each year, and that adds a little bit of complexity, adds a little bit of cost to your tax preparer. It can also get frustrating if that K1 is not timely. So, in addition to asking Andy, what is the tax status of this investment opportunity, I would ask, who's your accounting firm? And I'd ask them, when did you get your K1s to your investors last year? And hopefully they say February or March.
Yeah.
But if they dodge the question, or if they say we didn't get them till September or October, or we still haven't gotten them out to them yet, that might be a red flag that maybe there's not some ducks in a row. And it's going to be, if it's a little bit of a headache getting the K1, no problem. If it comes in a timely manner and everything is neat and ready to go, not a big deal, well worth it to get the pass-through advantages. But it can be frustrating, and some people are waiting to do their tax returns from a year ago toward the end of the next tax year because they're waiting on K1s.
Right. Yeah. And as an LP, that is, what did I just say? I love being an LP and no headache, no liability. That's actually the headache, right? Is waiting on the K1 sometimes. Well, so usually they're going to say the tax status, we're a partnership LLC, but what's something else they could say, that they're a C corp or an S corp or whatever, and then they're subject to, then we're paying double taxation, right?
Yeah, that's right. And if they say anything besides we are an LLC, a partnership, I would ask why, and I would understand the tax consequences of that, why they made that decision. I guess I've seen projects structured as REITs, for example.
Mm-hmm.
But I'd ask why they made that decision and understand the tax consequences of it compared to what's the kind of the more traditional route, which is the partnership.
Because yeah, and that's a good point, because there's usually a reason, right? It's not as going to be
Hmm.
as simple as like, oh, it's not a partnership LLC. You did it wrong. It's usually, you want to hear them out.
Yeah.
Again, every deal is different, and there are so many factors that go into a deal that you want a GP who's been really thoughtful
Yep.
about how they structure the deal.
Yeah. Hopefully you don't get a blank stare back. I don't think you would, but it's worthwhile to understand why they structured it the way they did.
Okay, so I've ascertained this is a partnership LLC. What's my next question for a GP?
So the next question that I would ask is about depreciation, because this is really one of the big tax benefits of investing in multifamily real estate is that the project is going to be depreciated, the asset is going to be depreciated, and if it's a partnership, that depreciation is going to flow through to you as a limited partner. And that's great. So that's great because Andy, non-cash expenses are awesome for tax efficient investing purposes because they're non-cash. So there's no cash going out the door, and cash is king, but they are an expense, which means that it reduces your income. And when you reduce your income, you reduce your tax liability. So that's why we love, as LPs or as real estate investors, we love depreciation because it lowers your tax liability without lowering the amount of cash that you can expect to receive. So I would ask the general partner what they are doing to accelerate the depreciation. There's a time value of money. So, all else being
Mm.
equal, you want to front load that depreciation as much as possible. And a lot of times they're going to tell you, well, we're going to do a cost segregation study, which basically means instead of depreciating everything over 27 years, we're going to break it down to say this much is allocated to buildings, this much is allocated to furnitures and fixtures. And those furnitures and fixtures are great because instead of depreciating over 27 and a half years, we can depreciate over 5 or 7 or 15 years.
Right, because the
And we
IRS they basically categorize every type of fixture or improvement, and there's a statutory or regulatory or whatever. There's a set depreciation schedule, and you want to have as many 5-year and 7-year depreciation schedules as you can, right?
Absolutely. That's right. So front load it as much as possible. Now, I do want to have a little asterisk or a caveat here. Andy, you asked at the top of the show, what's the difference between being a GP and an LP? And this is one of the big areas is if you are an LP, if you are not a real estate professional, and there's some tests that can be done to determine if you are a real estate professional.
Mm.
You've got to spend 50% of your time in the real estate business, at least 750 hours a year. You've got to be actively involved in it. So for most LPs, they're not going to meet those criteria, right? Andy, the deals that I'm an LP in, I am not a real estate professional. I don't think you're a real estate professional. And what that means for us is that we can only use losses, passive losses to offset passive income.
Right.
So when this depreciation, the losses from depreciation flow through to us as LPs, we can use those losses to offset, those are passive losses, and we can use them to offset passive income. So what we can't do is use them to offset active income. So income from wages or income from businesses that we are actively involved in. Whereas the GP, or if you are a real estate professional, you can do that. So what that means, Andy, is I'm getting a little bit complicated here, a little bit into the weeds, but I want LPs who are listening to this to understand that the tax benefits of depreciation to them are not quite as great as the tax benefits to GPs because they're not able to use them as quickly. A lot of times LPs will end up, if they can't use all of the passive losses in year one, they'll carry over to future years and they will still end up using them eventually. But again, there's a time value of money. And if you have losses that can be used to offset income, you'd like to use them as quickly as possible. So suffice it to say, LPs can't use these pass-through losses as quickly as GPs can. So they're slightly less tax advantaged.
Although that also kind of depends, I'm going to go back to what you said you got annoyed about, which is that everybody says it depends. Because if you're a family office and you're invested in a dozen different, you're an LP in a dozen different passive private funds. Some of them are multifamily, some of them are oil and gas, some of them are industrial, whatever they are. And you've invested at different points in times, a lot of times those losses, that depreciation is more upfront. And then in the back end, year 5, 6, or 7, those might be throwing off quite a significant amount of cash income. So if you're staggering your investments over time, then it's quite likely you're going to have that passive income from previous deals. You make a new investment, you get some new depreciation to offset that existing income. So I guess for me, it's more of a concern on that first couple of deals where you're an LP, right? Where you might be creating passive losses and have no other passive income against
Yep.
which, is that correct grammar? Against which to offset them.
Yeah, you're absolutely right, Andy. For a lot of LPs, they're going to have significant passive income, and they're going to be very interested in using passive losses to offset that income and lower their tax liability in the current years. So yeah, a lot of LPs may not need to carry forward those losses to future years. They might be able to use them all as quickly as they can get them.
Yeah, and it one other note there that you can carry them forward. I mean, that's a really important point because ideally, even within a multifamily fund, a private fund, hopefully hopefully they're showing a loss, right? In those first couple of years, in a way, like you want the depreciation to more than offset the income, right? Like that'd be like a good thing on paper if they show a loss. But even just that offering in and of itself should stabilize and be producing positive income, hopefully in year 3, 4, whenever that stabilization date is. And so even like within that own fund, you can carry those losses forward, offset income in year 3, 4, 5, 6, whenever. Um, so yeah, it's not quite as good though. I think you're right. It's like a 7 out of 10 benefit, right? The 10 out of
Right.
10 would be this depreciation creates a loss on paper that I can use to offset active income. That would be the 10 out of 10.
That's right. Well said.
So what's the next question I need to ask about tax benefits?
So the third question that I would ask is if they are anticipating making any tax-free distributions over the life cycle of your investment. So tax-free distributions are that's great, right? If you can get cash in your pocket without having to pay taxes on it, that's the holy grail of tax efficient investing. So how could this happen? The way that it most often happens is that the fund manager anticipates doing a refinancing. And you typically do a refinancing when the risk of the project has been mitigated. So, for example, if the multifamily project is ground up construction, they'd likely get a construction loan that's going to have a higher interest rate because at that point, it's a risky project, right? There's a pre
Right.
construction, there's a lot of risk associated with the project. Is it going to be on time, on budget, et cetera? Once construction is done and the lease up is done, that project has been significantly de-risked. The developer has eliminated a lot of the risk associated with the timing, the expenses. Are they able to get the rental rates that they anticipated? So if everything goes smoothly, they would be able to get refinance and get, instead of a construction loan, what's called permanent financing, which would typically come at a lower interest rate. And at that point, the project is also worth more if everything has gone as planned.
Mm.
So if you're even at the same loan to value that you were before, the value's gone up, so you're able to get a bigger loan. So what a lot of developers and fund managers will do is they'll refinance, they'll get a new loan, they will pay down the old loan, and then there will be some money left over in a lot of cases, and they will distribute that as a return of capital, not a return on capital, to their limited partners. And that one letter, return of versus return on, can make a big difference
Right.
from a tax perspective. And again, this all depends. There's a lot of wrinkles here, Andy. But I'd ask them if they anticipate making any tax-free distributions over the life cycle of your investment, and if so, how. And I just kind of walk through what the most common answer is going to be, but they may have other strategies too for getting tax-free distributions to their investors.
Yeah, and you mentioned ground up construction, I believe. So, that typically they're targeting what a refi like in year 3 or 4
Yep.
with a value add. Sometimes they're targeting it more quickly, right? Sometimes they're trying to complete the value add in 12, 16, 18 months and hopefully have that refi done, within 2 years. So the schedule is going to be different, for every project, for every offering. So I think also the timing is really important, right? Like in qualified opportunity fund, a lot of times they'll talk about the timing of that refi because you deferred some capital gains tax that you already owed to even invest in that qualified opportunity fund. Then that refi, that cash return of capital that you're going to receive will then cover your tax bill. So the timing of this stuff is pretty important. So I mean, in my opinion, you should ask about that as well.
Yeah, absolutely. And it's worth noting, Andy, they're probably going to caveat this, but this is according to their plans, according to their pro forma, right? And things don't always go as planned. Like I think it's the Mike Tyson quote that everyone's got a plan until they get punched in the mouth.
Hmm.
Things don't always
Everyone's
go as
got a
planned in
plan
real estate.
until inflation hits 10%
Yeah,
and interest
right.
rates get jacked up by 400, 500 basis points.
Great examples of you know plans that may have gone awry or that may not have gone exactly as anticipated
Hmm.
a couple years ago and got thrown some pretty good curveballs.
Yeah.
So they should caveat that, but worth noting that this is all as planned, and things don't always go as planned.
Right, but it's a good sign if they at least have a good answer that they're planning, right? It's a really,
They
or
should
I,
be planning on it. Absolutely right. Whether or not they're able to execute perfectly on their plan is another question, but they should at least be planning on it.
right. It's like it, it's it doesn't mean everything's going to go as planned, but if they don't even have it planned, I would say that's a very negative indicator. If you
Sure.
know,
Yeah. Yeah.
I,
Andy, I've always said, like, as I've prepared budgets and models, I'd say to people I'm presenting it to, like, the only thing I know about this budget or this model or this plan is that it's wrong. Like, something in here isn't going to go perfectly, right? The only thing
yeah,
I know with certainty is that what I'm showing you is wrong. But it's the act of having that plan that delivers a lot of value.
and a good GP, on that note, a good GP is able to pivot, right?
Yeah.
And
Yep.
I'm seeing this with GPs that I know personally with offerings that they may have launched in 2019, 2020, 2021, and they're already 2 or 3 years in. And in some cases, they're pivoting, right? Like maybe an asset was planned to be office, and now they're, permitting it differently, and it's going to be multifamily. Or in some cases, one multifamily fund that I'm invested in, that I'm an LP in, um, they were going to do smaller units, and then they decided to switch to townhomes because just the market conditions changed,
Mm.
and this is going to yield, per I don't know the exact verbiage they use, but this is going to yield more cash flow, more favorable pricing for us out of this land, out of this deal. And that's a good thing, right? Like the fact that they're not following their exact plan that they showed me 2 years ago, 3 years ago when I wrote them a check as an LP. That's a good thing that they pivot, in my opinion. You have
Yeah.
to trust them. That's where that track record, I think, comes into play. The GP having that track record to where you go, you know what? I don't actually want to control every little thing as an LP. That's why I'm investing with you, because I want to trust you to make those decisions.
Absolutely. Great points, Andy.
So as we've talked through this, if I feel like we're kind of moving, we're kind of following these tax benefits through the life cycle of the fund, right? Initially, we talked about how is the fund structured? Is it an LLC partnership? And then some of that upfront depreciate. We want to accelerate that depreciation. And then we get to the refinance, return of capital. Is that going to be in year 3 or 4, or is that plan for? Now moving through that life cycle with our outline here, I think it dovetails very well. What about when we get to the end, presuming this is a 5 or 7 year hold, or whatever the planned hold is? That's really something you need to be thinking about, asking questions about before you invest, right?
Yeah, that's right. So one of the great tax advantages of real estate comes when you sell real estate, because there are a lot of ways to defer and eventually eliminate, in some cases, the tax liability, the capital gains liability that you have. Andy, I like to say that the two best times to pay taxes are later and never.
Hmm.
And that's essentially what the
I've never heard that
1031.
one. That's a good one. You got to use that more often. I like that.
So there's an opportunity for real estate investors upon disposing of an asset, and hopefully everything goes well and they've got a nice capital gain,
Hmm.
to roll the proceeds from the liquidation into another property. And if done correctly, take advantage of Section 1031. You can defer those taxes, so you don't have to pay the taxes. And eventually, when you die, there's a step up in basis. So if you're thinking about this as an asset that's left to future generations, you can potentially eliminate those taxes by getting the step up in basis upon your death. So this is fairly straightforward. The 1031, I think it's over 100 years old, Andy. Like, this has been around forever. It's been
Oh yeah.
discussed being on the chopping block, but fortunately, it hasn't been touched. So it's fairly straightforward. It's established. It's been around forever. it can be made a lot easier to do this if it's something that the GP or the fund manager is planning on doing from the start, and if they have a mechanism in place to allow their LPs to come along. So a lot of times what GPs will do is they will 1031 their share of the proceeds into another property, and thereby they defer the capital gains that they would otherwise have to pay, the capital gains taxes. And hopefully they've got a mechanism that allows any LPs who want to come along with that to do that. And hopefully you've had a great experience with them.
Mm-hmm.
The trust that you had in the beginning has only grown, and you know, got positive return, and are interested in continuing on with that GP, with that developer. And you say, yeah, I want to take my share of the proceeds from the sale. I want to 1031 it into a new property that you've identified. The capital gains that we're realizing here, we're not going to have to pay taxes because we're taking advantage of Section 1031. Andy, I won't go into too much detail here. You mentioned, I know you just done an episode recently on 1031s that folks can go listen to if they want to really get into the weeds. But the GP can make that easier for their LPs to come along with them if they want to.
Yeah, that's a really important point. So I want to clarify a couple things. So I could still potentially do a 1031, even if the GP doesn't have anything, specifically planned or whatever. I can
Right.
still potentially do one as an
Yep.
LP, right?
Yep. It's a little more complicated. It's going to cost you more. And it's, I say these are fairly straightforward, but there's failed 1031s all the time where there's certain deadlines you've got to meet. Deals fall through all the time. So it's certainly be easier if you can just essentially what I've seen some GPs do is you can cast a vote essentially and say, "Yep, I want to roll with you. Let's keep this train moving," and then they kind of handle everything for you.
And wow, I got to say, I want to pause you there and just talk about, you use the word easier. They make it easier. I want to talk about the importance of that
Hmm.
because I think some LPs, especially newer LPs, might be listening and they're like, well, what's the big deal? I can do a 1031 no matter what. But the fact of the matter is, so many real estate investors who could do 1031 exchanges, who should do Section 1031 exchanges when they dispose of assets, even the ultra high net worth investors, even family offices, so many of them, a huge proportion of them, don't do 1031 exchanges. And
Hmm.
and not for any like smart reason. Like, not to call, I'm not calling out anyone in particular, but I guess if you're listening to this right now, you might kind of be raising your hand going, yeah, that's me. I did that.
Yeah.
But sometimes it's just I don't have time. Don't have the paperwork figured out. I missed this deadline. So making things easy, like, to me, that's a huge benefit, just making things easy. It kind of makes me think of Inland, just to have an example. I've had Inland on one of my other shows, and hopefully we'll have them on this show at some point. But they're a leader in the DST space, and they're always launching new DST offerings, and they have this track record going back a couple decades now in the DST space. And so, being with a company that has their stuff together, has a good track record, is organized, you can basically 1031 out of one of those DSTs and into another, staying with that good sponsor. And I mean, to me, there's just a huge value in that. It might seem like a small thing, but my point is, I don't think it is, because a lot of very wealthy investors, they mess it up.
Absolutely, Andy. And I see it all the time. I focus on tax efficient investing strategies. I mean, you wouldn't believe how many people fail to do easy things like max out their IRA, max out the matching on their 401k, just because it's not set by default, right? It's not made easy for them. And they, they miss out on so much money. They pay so much more in taxes than they should, just because it wasn't made easy for them and they didn't take the 10 or 20 or 30 minutes that it would have to save themselves a lot in taxes. Something to be said about human nature there. Maybe you should have a behavioral economist or something on the show to explain why we do these things or don't do these things.
Yeah, I think I'd enjoy that. So the two best times to pay taxes are later and never. The worst time to pay taxes is right now, right? So getting with a sponsor who makes things easy for you to defer, delay, whatever, there's those taxes. That's a huge benefit. What else, Michael? We've covered a lot of the heavy hitting tax benefits. What else should be on my radar? What else do I need to ask a GP?
Yeah, so we've kind of gone, I like the way you put it, Andy. We've kind of gone from the life cycle of a deal, starting up front through exiting. So I guess a bonus one here is I'd ask them, what else are you doing to maximize tax credits or tax efficiency? And there might not be anything. Like I don't think that the tail should wag the dog here. Like you shouldn't chase bad deals just because there's some potential tax advantages. But hopefully the GP is maxing out everything they can from the deals that they found, maxing it out from a tax efficiency perspective. So maybe that means they are chasing down low income housing tax credits or new market tax credits. Or if it's a historical preservation, if they're rehabbing, there can be historical tax credits that can be available. And then Andy, more recently, the Inflation Reduction Act that was passed in 2022 created some opportunities. I'm just going to read off a couple of them here. There's a new energy efficient home credit. Can get up to $5,000 a unit for developers of multifamily if they meet certain essentially clean energy or energy efficient housing standards.
Hmm.
There's energy efficient commercial building deductions. That's on a square foot basis. So you can get up to between 250 and $5 a square foot for commercial buildings, which includes multifamily. If they meet again certain energy efficiency standards related to HVAC and refrigerant standards that have been set by some independent bodies. So I'm not going to go into all the details here, but those numbers can start to add up pretty quickly. You're talking about $5 a square foot in tax credit, or $5,000 a unit in a tax credit. So again, there's the Inflation Reduction Act is in some ways a boondoggle for the multifamily industry, but there's money out there that savvy developers and savvy fund managers are going to know how to go after. There's a lot of different tax credits available. So to
I
summarize,
mean,
Andy,
thousands, right? Like there's literally thousands of if you go into the local and state. I mean,
yeah.
it's crazy.
Yep. And great point. There's some state specific programs too. I know that Ohio, for example, has some pretty generous historical preservation credits. They do some interesting things in the opportunity zone space as well, where they offer some additional credits on top of what the federal incentive offers. So, yeah, I know a lot about tax efficient investing with 50 states and all these myriad of different tax incentives. There's a lot. So, especially if it's a developer that operates in a specific area and really focuses in one place or a handful of places geographically, they should know all about the state-specific incentives available. And again, I don't want the tail to wag the dog here and just chase tax credits at the expense of the overall deal return.
Because
But
the
I'd
whole
ask
point,
them,
yeah, but Michael, on that point, it's like back to the depreciation thing. The whole point is to have positive passive income that I would want,
that's
deduction
right.
or tax benefits. So I totally agree on not having the tail wag the dog. But when you can stack these things together and have 3 or 4 different tax programs in one fund, I mean, it kind of gets me excited. I mean, the note to any GPs who are listening right now as an LP, if you want to sell me on your fund, that to me, I just love hearing, about these stacked tax incentives.
Absolutely, Andy. They're three of the sweetest words in the English language: stack tax incentives. A tongue twister too. So
Yeah, exactly. Yeah, I did just tripped me up. Stacked tax incentives. Wow. Yeah, that's the letter X, I think that gets you. Um, Michael, this has been awesome. I feel like I'm equipped. I have my 5 questions I'm going to ask every GP just about taxes, by the way. This is not an exhaustive list of things to ask a GP. If they're whining and dining you, really just on a Zoom call with you, but you have their time and attention, use it. It's not a bad thing to ask 10, 15, 20 questions. The point isn't to stump them. I mean, my thing, to be quite frank with you, Michael, I'm not an expert in all of this stuff. I'm not an expert in underwriting. Sometimes, in my opinion, as an LP, you want to ask questions and just get a GP talking because you're going to learn about them. You're going to learn about their personality. You're going to see how poised they are, just how they phrase certain things. It's like I guess it's an opportunity where they could answer something in a wrong way, in a way that you're like, is, you don't trust them or whatever, or quite the opposite. Sometimes people will like they'll admit to mistakes or whatever. They can do things that will impress you with their honesty or bring up parts of their track record maybe you didn't know about. So in my opinion, this is what LPs need to be doing. They need to be getting on the phone or on the Zoom call with the GP and asking questions. It doesn't need to take all day, but ask some questions, right?
Absolutely, Andy. And hopefully, to your point, you don't get blank stares back. You get thoughtful explanations. These are things that they've thought through, and you grow your confidence in their ability to execute on what they say they're going to do.
Love it. And thank you for all these tax insights, Michael. For our listeners and viewers who'd like to get some more tax efficient investment insights from you, where can they find your podcast?
Yeah, the easiest way, Andy, is taxefficientinvestor.com. And we cover tax efficient strategies, not just on real estate, on backdoor Roth, solo 401ks, you name it. If it's tax efficient in nature, we're going to be talking about it.
Awesome. We'll have to have you back on the show again soon. But Michael, thank you for joining me today.
Yeah, my pleasure. This was fun. Thanks, Andy.